Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Into the new year, Phil, with new numbers, right? So as always, they make changes and things to the little different items that we got to keep an eye on. And the first quarter of the year, we're all thinking about taxes and whatnot. So let's talk about some of the updated stuff that we probably need to know for this new year.
Tis the season.
Yeah, so. Tis the tax season. Right? So let's jump in and talk about a few of these things.
Sure.
We'll start with the COLA. The cost of living adjustment, which, I love. My mom said years ago, she's like, now that I'm on Social Security, they keep giving us this cola, but it kind of stinks. It's like a diet cola. And it just kind of stuck with me. I thought it was funny because they do give you something, not every year, but they have recently, but then they also kind of claw some of it back. So tell us about some of that stuff.
Yeah. So this year, 2.8%, a little bit higher than last year. Last year was 2.5.
Okay.
But kind of the trend over the last 5 or so years, it's down, which is a good thing. I mean, that means inflation is starting to kind of subside and stabilize. So, everyone likes to get those 5 and 8% COLAs, but the reality is if you look back to those years, everything else, from a cost of living standpoint, increased pretty substantially.
Yeah, 22 to 24, we had those higher ones for Social Security.
Yeah. And I mean, that is what this is intended to do, is to help Social Security keep pace with inflation. Doesn't track, typical cost of living adjustments. It's tied to wage earners. That's what the wage base is, what's used to determine what your Social Security benefit is.
Yeah, it's interesting, right? There's a lot of CPIs, and they don't really use the one that's actually for seniors. They use the urban worker one.
Yeah. It's the one that is tied to wages, which, the reason behind it is that it is a wage-based benefit. So
Right. Yeah, it's just interesting that because there is one for senior, I think, as well, a CPI for seniors.
Yeah, there's a CPI for seniors, looking at that basket of goods that the senior more typically consumes.
Yeah,
but
interesting. Anyway, go ahead.
So that's where it's at. We did get an increase. To your point, it doesn't happen every year. Typically later part of the year, October, November timeframe, we're finding out what the COLA adjustment is for the next year. Mm-hmm. Around the same times, we find out what our Medicare changes are for the next year.
And that's where they claw it back at, right? So typically they give you a little something, but then Medicare eats it up. So what's the change there? Yeah,
and sometimes it eats all of it up. This year it ate up a pretty good piece of it. So Medicare Part B premiums for this year went up to $202.90.
Okay.
So if you look back at what they were last year, $185. That's a pretty substantial increase. It's
like $20 almost.
Yeah, $17.90. So almost a 10% increase. So people are thinking, it's 2.8. They gave us, but they took away 10%. Well, different bases, right? Your Social Security, hopefully your Social Security is much more than the Medicare premium, at $200 a month. So, it's based as a percentage of the benefit. But that being said, for a lower earning Social Security benefit, it can eat up a pretty substantial portion of what that increase is.
I think I saw somewhere that the average Social Security one was about $40. The increase, about $40 and some change to their check, and then it's taking back almost 20. So it's hefty, and it's the second largest dollar jump in Medicare's program history. So
it is. So
that's a little bit of a bite.
A little bit of a bite for sure for retirees. But again, if you look at kind of what's going on, if you happen to be pre-Medicare and are paying your own premiums, you're self-employed. This year, 2026 saw a substantial increase in premiums. Yeah. So
true. Very true. Okay. So that's kind of on the Social Security Medicare side. Now, what about for some additional stuff? Now, obviously, we kind of talked about this at the end of the year, but since we're into the new year and things are rolling, let's kind of rehash it because, again, it is something you're going to want to do with filing this year, especially for this first one, because the OBBA, which I love saying, it sounds like somebody's grandfather. Hey, that's my OBBA over there.
Sounds like something you play in the high school band.
Yeah, there you go. But it's a lot easier than saying One Big Beautiful Bill Act. But that senior deduction, that is retro for 25, right? So you can do that when you're filing this year.
Yeah, so that is something that did come into play for 2025. And we used that a lot in our planning towards the end of the year when we were looking at Roth conversion. So that was pretty sizable benefit for people for 2025 and then going forward, where those over age 65, you get an additional $6,000 per person. So another $12,000 in deductions, not a credit. So depending on what your tax rate is, you get an additional deduction to help offset some kind of income. In our case, a lot of it was with Roth conversions. But if you don't have Roth conversions or your income stayed pretty consistent, you should see, all things equal, this year a sizable refund because you have an additional $12,000 deduction that you didn't have in previous years.
Yeah.
If your tax withholdings didn't change. So
unless you're higher income, right? Because it does start.
Yeah.
To
So
phase.
there is a phase out limit. So for married couples, it's $150,000 of AGI, modified adjusted gross income. So if it's above that, then you start to lose a portion of that $12,000.
Yeah. It's not a cliff, right? It doesn't drop off a cliff. It
Correct.
gradually phases down.
Correct.
Yeah. Okay.
Yep. So as you go over that, you start to lose a portion of that $12,000. For singles, it's a $6,000 benefit, and then or deduction, and then the adjusted gross income threshold $7,500 or $75,000. So
gotcha. Yeah.
So yeah, in that case, you could lose a portion of it. And again, to your point, it's not all of it. You gradually lose it. I think it's 2% of the amount over. So it takes a while.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
All right, so that's on that senior deduction. Now, the catch-up contributions, every year, those tend to change a little bit, right?
Yep.
So let's talk about those adjustments for 26.
Yeah, so if you are still working and contributing, if you're over age 50, you do have the ability to make this catch-up contribution. So for 401ks, 403bs, company type plans, it's $24,500 for this year.
That's across the board for anybody.
Right, for the base for anyone. Yeah. Once you get above age 50, it's another $8,000, which is an increase this year. It was $7,500 in prior years. So it's a little bit, and that's typically what they do is they do adjust it each year, but they're not going to reflect the adjustment unless it's in $500 increments. So once it hits that $500 threshold, then we jumped because it stayed at 75 for the last couple of years. This year we crossed it. So they did give us the extra extra 500. So it's at $8,000 now in catch-up contributions.
Yep.
So if you are contributing to a 401k, and you're over age 50, 32.5 is the threshold this year.
Which isn't bad. If you're thinking, a lot of times people feel like, hey, I'm behind. If you turn 50 this year in 26 and you can put away 32.5, and let's say you do that for the next 10 years.
Right.
That's, 300 plus grand for retirement. It's not chump change.
Right. That does help you catch up.
Yeah, that's right in the title. They actually appropriately named something for once, right?
That's right. Not with some crazy acronym or something.
Right. But there's also its cousin, the super catch up.
Yeah. So if you are still working in 60 to 63, then they give you $11,250 as the catch up contribution. So another, what is that? $3,250. You get to contribute. So
it's almost 36 grand.
Yep. Yeah. So over that 4-year time frame would be. So.
Now let's throw a caveat in there. So Phil, these are workplace plans, right?
Correct.
But in 26 now, that new rule also kicks in. If I'm correct here, if you make more than $150,000 and you're contributing to a workplace plan, it has to go into the Roth. That is a new wrinkle this year, right?
Correct. Yeah. So
for
this year,
high income earners, right?
For high income earners, that does flip, and you do have to, for the catch up contribution, have to contribute to the Roth.
Yeah.
And that's just for company plans.
But the downside is, what if your company doesn't offer the Roth in their company plan? Well, you can't take advantage of it.
Right. You can't take advantage of it. It has to be part of a Roth plan.
So you may want to, if you're watching this, you may want to check with your work, right? Yep. And talk with them about that. And if they're not doing, leave us a comment down below about what you think about that, by the way, because that's an interesting wrinkle that a lot of people just aren't aware of.
Right. Yeah. So make sure you did look at your elections at the end of the year. Your HR department should have contacted you. It should have been part of that process. They should be well aware of what's going on. But
right.
But if not, it's early in the year. You might not have gotten to pay yet. If you have, well, you're going to have to do some backtracking and get it figured out. So,
yeah.
But
I mean, more companies are adding it, but there's probably still some out there that
yes.
aren't. So,
Yeah, I mean, it is very common anymore. It's definitely in the minority, the companies that don't have the Roth
probably
provision.
smaller ones, but
Yeah.
still,
Yep.
it's an interesting wrinkle. And again, if you're making over 150,000, and that's not a married number, right, Phil? That's just an individual.
No, that's correct. Yep.
Yeah. Okay. All right. What's some other items?
So a couple other items that are coming into play this year, the SALT deduction,
Right. Yep.
get increased from 10,000 to 40. So that is a pretty sizable advantage that you might be able to pick up and start to itemize. I mean, a lot of people have gotten used to not itemizing because of the high standard deduction that we've had. But if you're in a state that has property taxes, and has a state income tax like Michigan, there's very possible chance that you might be able to get over that threshold now, depending on your scenario. If, especially if you do contribute to charity, you have a mortgage, you're living in a state like Michigan where we've got a state income tax as well as rather high property taxes.
Yeah.
A lot of people did get capped out at that $10,000. So likely that you might be able to at least get closer, maybe edge above that standard deduction item.
Okay.
But, again, something to keep in mind here, and this does affect a lot higher income earner, that if your income is above 505 in modified adjusted gross income, you're going to start to lose that 40,000.
So over 500,000.
Right, over 500,000, and it phases out pretty quick. It's 30% of the amount above the 500,000.
Oh, okay, yeah.
505. Then it starts to decrease back to 10. So 10 is going to be the floor. You're never going to lose all of it.
Gotcha.
But that additional gets reduced back, and that does get indexed. This is one of the few that gets indexed. So that for this year actually is 40,400 is the threshold. So.
Okay. All right. Yep. So that's the SALT one. And again, you probably want to be talking with your CPA if you're planning on going through the itemization, because there's just a lot more hassle and you want to make sure. And you're probably doing that anyway because you probably have a lot more assets to deal with. But
right. Yeah. So hopefully this is something you've already been looking at ahead of time, because, I mean, these have all, happened earlier in the year. So we knew what was coming.
Yeah, true. Okay. What else? And
then for charity, something new that's happening this year is the above the line deduction. So even if you aren't taking the itemization and taking a standard deduction, this year you're going to be able to take $1,000 for single, $2,000 for married of above the line charitable deduction.
I mean, it's not a ton, but it's something.
It's not a ton. It's better than what they did the last time. I mean, the last time we saw this come around in the COVID era, it was like $600.
Yeah.
So it's a pretty minimal amount. I mean, this is a little bit more respectable of a charitable contribution that you might see. So just keep it in mind, right? I mean, if you are giving to charity and you're not itemizing, well, this year it might count. You might end, or not this current year, but into the coming years it might count. So, just keep that in mind and look at it. One kind of goofy caveat with that is if you're contributing to a donor advised fund, well, that doesn't count. So you can't, the 1,000 or the 2,000 can't be a contribution to a donor advised fund. It's only to an ultimate charity, like a church or some other type of a nonprofit 501c3.
Gotcha.
So,
okay, good little wrinkle there. To keep
a little wrinkle in it, yeah. So they don't want you just funding a donor advised fund that might contribute or will contribute at some point in the future, but isn't, to that ultimate charity at this point.
They're trying to close the loophole.
A little bit. So, and then one other thing to keep in mind with charity starting in 2026 is we have this new threshold, this hurdle now we have to get over. So much like we've had for years in the itemized deductions for medical, the 7.5% of AGI is your threshold that you have to get over. Well, something similar now applies to charity. So now you have 0.5%. It's pretty low. So 0.5% of your modified adjusted gross income is that hurdle. So only those deductions that are above that threshold. So for instance, if you have, for easy math, modified adjusted gross income at $200,000, well, your hurdle, so to speak, is $1,000. So the first 1,000 of charity doesn't count towards itemization. So if you give 10, we only get 9 as your deduction on the standard or on the itemization. So
gotcha.
Just another little wrinkle.
Well, that's why it pays. To talk with a CPA, somebody who's keeping their eyes and ears on this. And of course, Phil's a CPA and a personal financial specialist. So that's probably the major ones, right? Going into the tax season.
Those are the major ones. Yeah, and one other charity item to keep in mind, and again, this only affects the high earners. If you are in that top marginal bracket, 37%, then and contributing, your charitable donations only effectively give you a 35% break.
Okay.
So, I mean, typically the way itemization works is the quote unquote tax benefit you receive is whatever that itemized deduction is, or that deduction is at that tax rate.
Gotcha. Yeah.
So if you're in the 37% bracket and you're contributing to charity, well, you're not going to get 37%, you're going to get 35%. So again, not a huge deal, but just something to keep in mind.
Well, some good stuff here on Phil's Tax Hacks and other retirement facts. I mean, whether it's Social Security, Medicare, taxes, retirement savings limits, those small changes can have noticeable impacts on your, on your plan or strategy, especially if you ignore them, right? So that quick review now can help make sure 2026 hopefully goes a little smoother and works with your plan versus against it. So if you need some help, reach out to Phil, of course, give him a jingle. We'll have the links in the show descriptions down below. We got the number on the screen, got all that good stuff happening. That way you can have a chat with him about your situation if you need some help. And don't forget to check him out online also at philstaxhacks.com. That's philstaxhacks.com. And subscribe to the channel right here on YouTube. Certainly supports it. We certainly appreciate it. And we put out content every week. So with that, we'll see you next week. Thanks, Phil, for breaking it down, buddy.
All right, take care.
We'll catch you next time here on Phil's Tax Hacks and other retirement facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.